To the untrained eye, a government bond appears riskless. The principal is guaranteed, the coupons arrive on schedule, and maturity dates are fixed. But beneath this calm surface lies a powerful engine of volatility, interest rate sensitivity. In 2022 alone, the US 10-year Treasury lost over 15% in market value, not because it defaulted, but because its duration turned against it as yields rose sharply. For investment analysts, duration is not a technicality. It's the very metric that translates central bank policy into portfolio impact. It tells us how far into the future our returns lie, and how vulnerable they are to rate shifts. Let's decode duration and explore how even a small move in interest rates can cause a big dent in fixed income value. In simple terms, duration measures how sensitive a bond's price is to changes in interest rates. It is often expressed as a number of years but reflects sensitivity, not time. There are three main versions of duration. Macaulay duration, the weighted average time to receive cash flows. Modified duration, adjust Macaulay to show the percent price change per 1% change in yield. Effective duration incorporates changes in cash flows, for example, call options. As a rule of thumb, modified duration multiplied by the change in yield is approximately the percentage change in price. But what does this look like in numbers? Let's walk through a simple example of how duration works in practice. Imagine a plain vanilla bond with a par value of $1,000. It pays a 5% annual coupon, which means you'll receive $50 each year, and it matures in 3 years. Now assume that the prevailing market yield is also 5%, so the bond is priced at par, exactly $1,000. To calculate the bond's Macaulay duration, we begin by discounting its future cash flows back to the present using the market yield. In the first year, the $50 coupon is discounted by a factor of 0.9524, giving a present value of about $47.62. In year 2, that $50 coupon gets a slightly steeper discount, 0.9070, resulting in a present value of $45.35. The final year delivers the $50 coupon and the $1,000 principal, for a total of $1,050, discounted at a factor of 0.8638. This lump sum has a present value of $906.96. Add these three present values together and you get a total of $1,000, as expected for a par bond. Now we weight each of these present values by the year in which they're received and compute the average. The math looks like this. Year 1, $47.62 divided by $1,000 equals a weighting of 0.048. Year 2, $45.35 divided by $1,000 equals a weighting of 0.045. And finally, Year 3, $907.03 divided by $1,000 equals a weighting of 0.907. Add them up and you get 2.86 years. That's the Macaulay duration, the weighted average time it takes to receive the bond's cash flows in present value terms. To turn this into a measure of interest rate sensitivity, we convert it into modified duration. This is done by dividing the Macaulay duration by 1 plus the yield, in decimal form. So modified duration equals the Macaulay duration of 2.86 divided by 1 plus the yield of 5%, which equals approximately 2.72 years. What does that number mean? It tells us that for every 1% change in interest rates, the bond's price will move about 2.72% in the opposite direction. To quantify this, imagine market yields rise from 5% to 6%. The bond's price would fall by about minus 2.72% x $1,000, or $27.20. In other words, a seemingly small 1% rise in yields translates into a $27.20 capital loss on a $1,000 investment. That's the practical power and peril of duration. Even in short duration bonds, rate changes can meaningfully affect value. This simple calculation tells us how a bond reacts to yield changes. For a 3-year bond, a 2.7% price loss may seem small. But for a 30-year bond with a modified duration of 18, the same 1% yield increase causes an 18% capital loss. Duration is thus a first-order risk metric. It's the delta of the bond world, showing how prices shift with rates. Longer durations equals more risk. But here's the twist, the relationship isn't linear. We will pick up on the issue of convexity as a separate video in this playlist. Be sure to check it out. It's an important concept. Silicon Valley Bank, SVB, is a stark reminder that duration isn't just a risk metric, but a survival metric. In 2020 and 2021, flush with customer deposits from a booming venture capital ecosystem, SVB faced a classic portfolio management problem: how to deploy a surge in low-cost liabilities. Instead of opting for flexibility or balance, the bank loaded up on long-dated, fixed-rate US Treasuries and agency mortgage-backed securities. These instruments, while credit-safe, were acutely rate-sensitive. The average duration of its held-to-maturity (HTM) book exceeded 5.6 years, a level more typical of an insurer with long-term liabilities than a bank with volatile, demand-driven deposits. At the time, the decision seemed defensible. Yields were historically low, and the Fed still projected a long runway before rate hikes. Yet the entire premise rested on a critical assumption: interest rates would stay low for the foreseeable future. It was a massive duration bet, implicitly long duration, and it was left unhedged. That decision unraveled quickly in 2022, when the Federal Reserve pivoted aggressively in response to surging inflation. The Fed funds rate climbed from near zero to over 5% in under a year. Bond yields followed suit, and the price of fixed-rate securities tumbled. A 5.6-year duration implied that a 300 basis point rate rise could slash bond prices by over 15%, exactly what played out in SVB's portfolio. Critically, because these bonds were in the held-to-maturity bucket, the losses were not reflected on SVB's balance sheet until they had to sell. That's where duration turned from theoretical risk to existential crisis. As the tech sector cooled and interest rates rose, SVB's client base began withdrawing deposits to cover cash burn. This deposit flight forced SVB to liquidate parts of its portfolio to raise liquidity. The moment they touched their HTM book, the unrealized losses became real. In March 2023, the bank disclosed a $1.8 billion loss on a $21 billion bond sale, triggering panic. Within 48 hours, a full-blown bank run unfolded. SVB collapsed, not due to bad credit bets or exotic derivatives, but because it failed to hedge or actively manage interest rate duration. Worse still, the risk was knowable and measurable. SVB's filings showed the market value of its HTM portfolio was $15 billion below book value by late 2022. Any fixed income analyst or ALM professional could have flagged the duration mismatch. The problem wasn't opacity, it was inaction. What SVB's collapse teaches analysts is this: duration risk is not just for bond funds or pensions. It is systemic, cross-cutting, and deeply embedded in financial structures. An unhedged duration exposure, when paired with liquidity needs, can turn an asset-liability mismatch into a solvency crisis. The mistake wasn't holding long bonds, it was assuming they were safe simply because they carried low credit risk. In today's world, where interest rates can shift hundreds of basis points in a matter of months, every analyst must think like a risk manager. Duration isn't a dashboard footnote. It's a flashing warning light, and in SVB's case, one that was ignored until it was too late. Duration is more than a math concept. It's a mindset. It tells you how far into the future your portfolio is vulnerable, and how your bond positions will react to central bank policy, macro shocks, and yield curve twists. Investment analysts who master duration don't just avoid risk. They anticipate it, model it, and position around it. Whether you're assessing corporate debt, pension liabilities, or government bond ETFs, understanding duration is a superpower. So next time you see a safe bond, ask, what's its duration? Because that one number could make or break your return.